welcome to the Monday Futures Market Outlook for May 9th, 2011. This is Patrick Srezna. For those of you that have not had the opportunity to try out eminisource.com's trading room, a 5-day complimentary membership is available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. Back in the 2009 timeframe, we bullishly crossed above that and have remained bullishly above it since. Ultimately, we were looking for some sort of a rally to come to an end somewhere below 1400, around the 1380 level on the upside, and subsequently begin a corrective wave within the markets. We don't necessarily believe that this has to be the beginning of a new bear market, but rather just simply an important sell cycle within the normal buy and sell cycles within the stock market. We have now approached that sell and may go away period, with markets hitting highs up along the targets where we had. And so really at this stage, looking for even a 3 to 4 month market consolidation over the summer is becoming an increasing probability. Just to review our key intermarket observations, there is not enough evidence for us to officially change our current intermediate bullish bias on the market, but with the market now reversing off the upside targets for the year, there's an increasing probability that we have seen the highs of the second quarter, and even a chance that it might end up being the highs of the entire year. We have been obviously anticipating that market top to come in around this 1350, 1380 area, but what actually particularly makes it very powerful is that it's occurring, the market top sort of occurring at the same time as we've seen that significant reversal in the US dollar, which completely has unraveled the commodity trade and subsequently taken the wind out of the sails of the market. There's a strong probability that this past week was the turning point for the market, for that intermarket asset class rotation to begin. And if that was the case, then we should be seeing a cycle that doesn't just last a week, but rather it should take even 2, 3, 4 months to finish playing out at minimum. And so so everyone must take a step back and try to understand things from a little bit of a bigger picture perspective, and not just look at last week on its own. When we take a look at that S&P 500 on the daily charts, you can see we were looking for that market high to come in somewhere up along here. You can see that the S&P 500 has yet to do any real technical damage. I mean, at this moment, there's nothing stopping the S&P from even potentially going up for a double top retest up along that zone before it comes back down. But overall, especially now that the US dollar is reversed, more than likely that was a key high level where the market should continue to reject off of that as the market continues, even if it does have a short-term push back up. Overall, if there's any break of this, these levels around this 1335 level on the downside, the 1330, anything that really starts to accelerate, we could see a move back down to the 1290, 1300 level relatively quickly. And overall, if that happens, and in a much bigger picture, then we should not only see 1250, 1260, but could even over a 3-month, 4-month period see even the lows come in as in the 1180 to 1220 area on the downside. But before we rush to see make those kind of forecasts, we first have to see further price action deterioration off of this existing level where we're at. So we'll want to see how a little topping formation continues to develop, how the price action is maturing up here, and recognize that this type of a forecast that we're talking about is really a 2, 3, 4 month scenario, and not what's going to happen in the next 2 days. So just watch how the market puts everything into motion. Next year, we'll take a look at the US dollar index futures, and this is where we saw that monster 2-day reversal driven particularly by European news, as the euro weighs very heavily in this index. That US dollar with this kind of a very strong pop is going to probably begin a short squeeze. It does the only way right now that the US dollar bears and the euro bulls can reverse this would be a very dramatic rally that drops the market back down below 74 in a very short time frame. But really at this stage, more than likely we have seen the low of the US dollar, probably even on a multi-month basis, if not even for the year. That's again too soon to make that any real big picture assumptions yet. But if this was the big reversal in the U.S. dollar and it bangs out the bottom off of those lows, we should see a U.S. dollar index that in the next 3-4 months can probably exceed that 77 to 77.50 area, if not even work its way up considerably higher, depending on how bad the situation gets in Europe and on a global picture. Next year, I want to take a look at copper futures, and as they call Dr. Copper, and essentially copper usually is an indication of the health of the global economy because the demand for the industrial metal usually can signify economic growth. We've seen an extended topping formation that we've continuously talked about, and that U.S. dollar short squeeze that occurred really dropped copper out of that sideways range bound into what is now clearly a new downtrend. While we certainly cannot rule out the possibility that on any short time frame, copper can get back to 410 to 420 on the upside. But in the bigger picture, unless there's a major reversal back in the U.S. dollar, we should see continued deterioration in copper prices down at minimum to the 370, 380 level on the downside. But in the much bigger picture, can get right down to 320, 340 on the downside over the span of a 2 to 3 month cycle. So again, any short-term strength here probably will emerge to being a shorting opportunity. Next year, I want to take a look at gold futures, and we were targeting the highs of the measured move for gold to come in around the 1580 area on the upside. We basically got that hit the other week, and I've now seen some very dramatic selling in gold, especially when that U.S. dollar finally reversed at this juncture. That more than likely has been a significant high in gold. Now, we again cannot rule out the possibility that over any short-term window, gold may even come back for a solid retest up into the mid 1500s one more time in the process of topping. But in the much bigger picture, we believe that there's little to no upside potential for gold over the next 3 to 4 months, and really believe that there's going to be some good, healthy market consolidations in gold. And now that doesn't make me on a weekly and monthly chart basis a bear on gold, simply recognizing that that gold goes through buy and sell cycles like any other asset class, and we have really seen the easy money in gold occur. And during a period where the U.S. dollar strength may emerge, gold should be an asset class that acts very poorly during that cycle. Next year, I want to take a look at silver futures, and we particularly started watching silver over the last 2-3 weeks because we knew that there was going to be a major market crash in silver at some point. We felt it was worth us documenting the occurrence of it, and just like clockwork, the highs of silver came in with a little double top around the 50 line. Reversals came in, and subsequently a complete collapse of silver price. Really, at some juncture here, silver is going to have a bounce, maybe even back to $40, $42 on the upside, but it will probably emerge to being a new shorting opportunity. Eventually, silver should work its way back to those consolidation levels around the $26 to $32 area on the downside, but that's something that will probably occur over months. The easy downside money on the short was already just made. Really, now it's a matter of just letting the weight of the decline. It's sort of like an avalanche coming down a mountain. Eventually, the weight will again overwhelm silver for another push, but the next wave lower will probably not be remotely as intense as the first wave what we just saw. Next year, I want to take a look at crude oil, and we were looking for the highs of crude oil to come in somewhere around the 115, 120 area. Crude oil never really made any progress up there, and eventually the one-day monster reversal occurred, which outright collapsed crude oil prices. Really, at this juncture, the crude oil top is in, and while we certainly can get a bounce of crude oil back to even 105 and give a $3, $4, $5 spurt higher, which will make everyone feel like buying oil again, it probably will only be a new shorting opportunity anytime you see crude oil work its way back up. Really, at this stage, if we are seeing a U.S. dollar rally that lasts for any substantial period of time, crude oil should make it well down into the $90 to even $80 area on the downside over a multi-month span time frame. So in the bigger picture, if you are stuck in any oil plays, use any short-term strength to reduce your exposure or build in hedges to your position. Finally, I want to take a look at the 30-year Treasury bonds, and we've been looking for the Treasury bonds to turn bullish, particularly when those intermarket analysis things kind of came into play. Really, at this stage, with all the reversals in play, this Treasury bond rally we're seeing should be a substantial one, and the beginning is really gone. Really, at some stage, again, we will probably have a pullback again on the Treasury bonds as it has to do some sort of a flag or wedge consolidation after what was pretty much a very good 5 to 6 week cycle higher. But even most of or any pullback that we do get in the Treasury bond market, I'm of the opinion that it will be a buying opportunity, and one should continue to position themselves into Treasury bonds, as this will probably be one of the few asset classes that should perform relatively well in a period where the stock market and commodities will be net selling. That was your Monday Futures Market Outlook. Thank you for joining me.